This conference will now be recorded.
So hope the screen is visible to you people. Can anyone confirm me? Is that screen is visible? Can anyone confirm? Is the screen is visible?
No, sir, it's not visible.
Okay, I'll reshare the screen. Is that now it is visible?
Yes, sir.
Okay, thank you for the confirmation. So in the last session, we were been discussed about training institute model. So where we have been add some data from the previous years. So what all the types of expenses, incomes, assets, liabilities which we are going to come across with. So we have been calculated with the revenue value in the income statement, and we had some profit out of it. Then we have been carried forward that profit and depreciations, then accounts receivable calculations. So there is a difference between one module to another model, right? So we have been completed with the balance sheet. So here there is a difference of value. You have it in this. Just a moment. Yeah, sorry for the inconvenience. So we were talking about how we can be able to get this cash difference so that we can be able to find it out through the cash flow statement. So let us go to the cash flow statement. So here it is going to ask for profit after tax. So this you are going to get it through the income statement. So let me connect it with equals to income statement from the year one and connect it for the other years. So these are the profit after tax values. The next thing is depreciation value. So depreciation value will be connected from the income statement only. So there we are going to reduce the value, but here we are going to add the value. So the next thing is the change in accounts receivable values. So Whenever we are going to have a balance sheet value, so here we are going to bring it. If it is a liabilities, it will be the current year minus the previous year. So when it is going to be related to the assets, so it is going to be previous year minus current year values. So you are going to connect it from the balance sheet. The accounts receivable, it's available in the balance sheet. So here, so it should be previous year. Okay, so let me connect it by using the equals to balance sheet, the previous year minus the current year value. So this is the formula what we are going to use it. Okay, sorry, it should be from the year 1 onwards. It will be equals to balance sheets previous year minus the current year. So in case if you are going to collect this back, okay, so these are the things which is going to get reduced from the statement. Okay, so now we are going to use the sum function of all this. So this is going to be the cash flow from operation activities. The next thing is the deposit value. So this we have been found out from asset and debt value. So here also we have been spent, the money has gone from our hand. So instead of me taking the total of an capital expenditure, I have been given with the difference, the values where the 76 lakhs, it has been divided into two parts, that is a deposit and the fixed assets purchases. So this will be the total of cash flow from the investing activities. The next thing is change in debt, that is nothing but the calculation of the debt raised and the cleared, paid, repaid. So this also we are going to get it from asset and debt value equals to, so opening value of the debt, or the same value we have been brought it in the cash flow statement also, oh sorry, balance sheet also. So let me take it. So the debt it was been raised equals to, then from the year 1 onwards we have been cleared, so that we have been given in the balance sheet. So as a balance sheet when you are going to consider, so you are supposed to use the formula of the present, the current year minus the previous year. So the present year is year 1 minus the previous year values. So when you are going to drag it, so let me give the formula that the current year minus the previous year. Now if you are going to see the total amount which is been paid, it will be equal to the debt what you have been taken. So 45 lakhs 60,000, and here also it is 45 lakhs 60,000. Then change in equity capital, it will be equals to the asset and debt value. Okay, so the CFF value is, it will be addition of both of these values and drag the same. So finally, the net change in cash, it is going to be, can anyone let me know what could be this calculation? Since we have been done with the multiple models, so can anyone try up how to calculate at least these three lines? The net change in cash, the beginning opening balance, the beginning opening cash, and end, sorry, beginning of the period cash and the end of period cash. So anyone can try, even if it is wrong also, it's okay. So let me give you a few minutes of time so that you can be able to just look into it. So can anyone try? So even if it is wrong, it's okay. But I want you people to find it out what could be the net change in cash. So you can refer with our previous works also. But I want anyone to try it out.
Sir, the net change in cash is CFO plus CFI plus CFF.
Yeah. So that is the total of CFO. Good. Thank you, ma. The total of CFI plus the CFF. Good. Yes. The next. So what could be the opening cash? So this is for year 0. So what is this beginning of period cash? So from where do we derive these values?
Sir, is it 0?
Yeah. So how do we get that as 0 now? So beginning of period cash means what? So how do we take that value? Is it all the years it is going to be as 0?
No, sir.
Okay.
It would be the sum, I mean, net change in cash. So it'll be like E18. That will be the value of beginning of the period cash.
Okay, good. You have been referring it. So beginning of cash is nothing but beginning of period cash is nothing but the opening balance. So what do you mean by opening balance? The last year's closing balance will becomes this year's opening balance. See, before the year 0, there is no year. So obviously there is no closing. So it will be 0. Good. So what will be this end of period cash? Good try. So what it could be with end of period cash. So you are able to answer it for the previous one, but the answer was related to this one. So you can recall that answer and you can try to let me know. Okay, so end of period cash is nothing but the money what you have it at your hand. So at the end of the year, how much do you have it? So that is nothing but what do you have it through net change in cash plus, and what do you have it in the opening period. Okay, so since both the values were zero, so this one also will be a zero. Then the BOP cash for the year one, it will be equals to the last year's EOP cash. That is last year's closing balance. End of period value will be this year's opening. Okay, same way you can be able to start with this equals to that year net change in cash plus this year's opening. So like this, you can be able to do it for other years. Equals to that year plus the current year. So I can select this and I can be able to drag it. Okay. So this is how we are going to bring up the final balance of the cash of that particular year period. So this will be connected to our balance sheet. So let's check it out. Is it the balance what you have it over here? Is it going to get matched up or not? So equals to cash flow statements end of period cash from the year zero onwards, and I'll drag it. You can make sure that this checksum it should be zero. So it has to get at this state. So that means whatever the value where difference we had it on the total. So now it has been fulfilled by this values. So when this checksum is going to be as a zero, so that means we have been done with proper way. Okay. So we have been completed with the income statement, we have been completed with the balance sheet, we have been completed with the cash flow statement. Okay, so it combines each and other, so it will have a connectivity so that we can be able to get to know that whether we are in uh, which position of the business. Okay, then finally we are going to know that, so can we be able to earn the money out of what we have been got it within all this calculation, whether we will be in a capable of earning the money out of this business with all this assumptions of the business. Okay, so if this gives more than cost of equity of expected is 20%, if it is more than that, we can be able to suggest to the client. So if not, we are not going to approach with it. Okay, so the next thing is the free cash flow equity value. So with this, we are going to see that equals to, I have to go for cash flow statement, and here the total of CFO plus CFI plus then change in debt. So these three values are going to give you the calculation of FCFE. Okay, now calculate the IRR. So internal rate of return. So this will be equals to, so the FCFE value, sorry, first you have to put the function of IRR and then you select all the values and close the bracket and press enter. So this is what the value you are going to get. Okay, so just give me a minute, I'll be back. Yeah, so we can be able to calculate this values, so by using the formula. Okay, so let me check it out. Okay, so here there is a small change. Just a moment, I'll just give up. Let me check with the value. So how much amount we have been recovered. Yeah. So if you are going to take it the values from the asset and debt values, so directly you are going to be able to get it at 20% of IRR. Expected rate of returns can be increased with, but as per the formula when you are going to calculate with, okay, it is the same values what we have been taken from the asset and debt values, but here we have been calculated with in the cash flow statement that we have been repaid the values. So it has been taken with the minus value. So it is going to give you with some kind of a change in values. So you can be able to you can be able to take a decision that how much you can be able to recover it with an equity. So if there is any change in the equity value, so you can be able to make with some kind of profit. But when you are going with, yeah, so when you are going going with clearing the debt, so within the 6 years, within the short term period, so there may be chances that since you are going to pay the money at faster way, the debt is going to get cleared. So the rate of returns what you are going to expect it is going to be little bit lesser than that. So if it is more lesser than the 50%, then it could have been, so directly we can be able to ignore with it. But in case of it is going to be more than 50%, it can be suggestible. So still it is on the uh, a kind of line. Then calculation of the net present value, so it will be equals to NPV. So what is the net present value? We are going to have it. So the rate of percentage is 20%. So let me check it out, recall it. Somewhere some values are missing. So CFS value is, yeah, let me take it from this. Yeah, Yeah. So finally, it is going to be, it is not a suggestible model what it says. So when we are going to calculate with, yeah, just give me a second. So let me choose it CFO plus the CFI value plus the change in debt value. Yeah. So this is what the value you are going to get it. So which is not suggestible business to the client. Okay. So like this, you can be able to work it out. So, and you have to look into the sequences where you can be able to make any small changes that we have been seen in the previous session also with the Volvo model. We have been made some changes in the ticket price changes. So we had a lot of differences. So everything we are going to here analyze it and where we can be able to make the changes. So either is it going to be worked out for them for the client, so we can be able to give with all the possibilities on the model. Okay, so by this we are going to end up with the training institute franchise model. So the next thing what we are going to talk is the assignment. So how many of them have been completed the assignment? So they can put it in the chat box that you have been finished with. So the people who have been finished, they can type it as finished. The people who have not finished, they can type it not. So if
So
any person is, yeah, yeah, you can go ahead with the
I
doubts,
have
ma.
few doubts. Can we ask now
Yeah, yeah, yeah.
or at the end of the class?
No, 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 you can. Is it related to this?
Yeah, the
The
assignment questions.
assignment. Yeah, yeah, go ahead, ma.
So can you once give a small heads up on how to do it a bit easy? So we are like, I don't know about others, but I got confused between how to do from the
No
start.
problem. No, no problem. So have you been logged in with your laptop or have you been logged in your mobile, ma?
Mobile, sir.
Through a mobile.
Yes,
Okay.
sir.
So can you give me a 2 minutes? I'll be back, or I'll take a 5 minutes of break, and I'll come
Yes,
back and run with the model. Okay.
yes, sir.
Yeah. Thank you all for being online. Sorry for the inconvenience. Yeah. Uh, Jaishnu, can you let me know that what are the things you have been recorded in your document? That is, can you see our document regarding the Bangalore Cafe model?
Yes, sir.
Okay. So here we have some informations that if he is going to sell the minimum of it, so how much is going to get charged for it? So that information you are supposed to put it over here. So here an average of sales can be expected for the first month is with this type of items with this quantity on every day, sorry, on the every month basis. Okay, so let us see that
Okay.
in the business model. So this I will take it as a month wise. This is price and this is annual sales. So let us see that in the month wise how much we are going to be able to sell it. So the tea is 100 quantity. So let us keep it like that. Samosa 50. So the Maggi is 50. The puff is 30 and 20. So this is what every month is expected. Okay. So here the price of it. So what is the price of each item? So that price it has been given over here. So the tea will cost you 20 rupees. So the next thing is samosa is costing you 30 rupees. The Maggi is costing you 60 rupees. Puff it is 80 rupees. Then shakes 150 rupees. Okay. So this is what the available data. Now let's see that what is the changes you will have it on the next year onwards. So here it says that every month on month you are going to have a 1% increment. Okay, so let us see that if there is a increment for, if there is increment, so how do we calculate with this? So here as we have taken it as a month on month, so let me keep this on this side and remove this values. So this remains the same. Only the sales part it is going to have a changes. So here let us keep it as from the year first itself. So this is going to be, yeah. So this is going to be only as a reference value I have taken it. But when it is going to come for the year on year increases, so I have to take it this value into monthly 1% if it is increasing. So then it is going to increase with 12%. So for the year it is going to be 12%, and it is 1%. So let me go back to once again with this average daily sales expected for first month. Okay, so sorry, again here we have to see that it is not monthly sales, it is going to be calculated as everyday sales. So here let us assume it on the year one. Sorry, I'll take this and I'm going to keep it over here. Sorry, I didn't see with this values. I was being confused with the increasal. I'll just take this. Yeah, I'll keep it like this. So instead of month, I'll keep it as a daily. Yeah. So on the year one, every day it is going to be the same values. From the year two onwards, it is going to get increased with 12% every year. So 1 plus 12%. Yeah. So on the year one, it remains the same. There is no any changes. From the year two onwards, it is going to increase every month with 1% expected uh, increasal for the year two onwards with a minimum of 1% on every month wise. So when it is going to be calculated as for the year wise, it is going to be calculated at 12%. Okay, so this is on sales. So let us see, is there any changes in the prices wise? So Sumit wants to set up a chain of cafes in Bangalore. Sumit has identified the location and the products that he wants to sell in this cafe. He wants to sell so and so. To operate the cafe, it needs to have a 450 square feet. Yes, there is no anything changes. Yeah. So when there is a sales increases, so let us increase with the value of it also. So let me increase with the price wise also with 12%. Okay. So 1 plus 12%. So let me increase with this. Yes. So we have been increased 12% per year per annum, and year also 12% per annum. Okay. Now finally, what could be the total annual sales? So this will be equals to T into the price is 20 into 365 days a year. So you can be able to earn it for every year. So minimum of 7,30,000 out of this sales. So now if I'm going to drag this and drag it to other years. So you can be able to earn it because of the change in prices. So with this values, the same product with this values. Okay. So the total annual sales will be sum of the annual sales. Okay. So now here, once we have been found out that this is my sales for the year on year, then there is something called online aggregators. So that means if you have been observed that today If I want anything to eat, so I can be able to get it through the call or with one app message. So I can be able to order it and I can be able to have it. So the people who provide such type of services, they are called as an online aggregators like Swiggy, Zomato, Danzo. All these people are considered as an online aggregators. So what the information we have it related to this? Yeah. So online aggregator says that 40% of the total sales they are going to take it. Okay. So on this they charge a 30% on the total sales. So here we are going to calculate it. So out of this value what you are going to earn it. Okay. On this, so they charge 30% of the total sales into 30%. And this is the remaining.
Sir, the 30% is for commission, no, sir?
So yeah, oh sorry, the commission it is separately it is given here. So this it is going to be 40%. Yeah, you are right, ma'am. So this is into 40%. The sales what has happened through the online aggregators, and this I will change it into 60%. But so now if you are going to add this, you are going to get the same value. 43 lakhs 43,500. Okay. So is that understood clear, ma?
Yes, sir.
Yeah, good. So the next thing is on the rent expenses. So is there anything we have it as an rent? Let's check it out. Yeah, it needs a 450 square feet. So where it is going to get charged at 150 per month. Okay. So it is equals to 450 into 150 into 12. So you are going to get charged with 8 lakh 10,000 rupees. So is there any increase of the rental? So no, any no such thing. So it is going to be the same rent for all the 5 years. So you are going to calculate it over here. Then the salaries. So the deposit for this it has been set as 10 lakhs. So for this renovation cost it is 15 lakhs. Then total investment is 25 lakhs. So now on this the debt is, so how much percentage? Let's see, 20% by bank loan. Remaining should be funded using the equity. So 20% out of this is a loan and remaining is on the equity value. Okay, then salary part. So it is going to be costed you. So per month it is going to get costed 20,000. Then cooking staff, it is three people required, 15,000 each. So let me calculate it over here. So equals to multiplied with number, and so this into this. Yeah. So this is the value. Let me put up the sum. It is going to cost you at 95,000. Yeah. So it is calculated. So this will be the salary per month equals to the total value into 12. So this is going to be the salary. Then next there is an increment in the salary, that is 7%. So we have to increase with 7%, 1 plus 7%, and this will be calculated for further years. So the commission value will be on whatever the sales has happened on through the online. On that there is a 30% commission. Okay, then interest expense will be on 5 lakhs 12% equals to the debt value into 12%, and it remains the same for all the years because the later period they are going to pay it in the lump sum. Then what is the food cost? So let us check it out. Is there any information about the food cost? So food expenses are expected to be 35% of the contribution. So whatever the sales you have it, on that 35%, the cost, so into 35%. So the PBT value will be equals to sum of all the expenses. Okay, so it is the total annual sales minus sum of all the expenses. Okay, so on this there is a tax. How much the tax rate is? 35%. So equals to 35%. And the profit after tax will be PBT minus tax. Yeah. So this is what the profit after tax what you are going to have it. So finally we are going to prepare with cash flow statement. So initial investment is equals to minus 25 lakhs. The debt what it was been raised 5 lakhs, and the same amount is paid at the end of the year. So end of the period of 5th year you are going to pay that. The deposit amount what you have paid of 10 lakhs will be refunded after 5 years, and the profit after tax value will be and the total cash flow will be sum of all the cash flow statement value, and IRR will be equals to IRR, and select all these values. So you will be able to earn 32% of returns in the year. Is that clear, Jeshnu? Got an idea? Are you there, Jeshnu?
Yes, sir, I got it. The mic
Okay,
wasn't unmuted, sir, so I couldn't reply fast.
no problem, no problem. So when we were expecting 20%, we can be able to make it 32%. Okay, so I'll share the answers also to you people. So cross verify, practice it, and we'll meet up in the next session. Thank you all. Have a nice day.